The new money supply numbers have just been released by the Federal Reserve, and it does not signal good times ahead. You know, I watch the money supply like a hawk, and it used to be released weekly. But about a year and a half ago, they started releasing the data monthly instead. And so now we have the data all the way through the month of January into the month of February a little bit, and it signals that we have some economic pain ahead. Here's the long-term chart. You can see the money supply had a relatively even pace of increasing all the way along here. And then obviously 2020 happened. They printed a few $1 trillion. And the total money supply started to explode. It kept well above trend, and then something changed at the end of 2021, beginning of 2022. The Federal Reserve started to tighten. They started to let assets bleed off their balance sheet. They started to raise interest rates, and these things together have an effect of tightening that money supply, of draining cash out of the system. There were some lagging effects from before, and the money supply peaked in April of 2022 and has been declining since then. That brings us to today with a 1-year decline, and the last month has been very steep. We haven't seen this steep of a decline since April of 2022. Now keep in mind though, this last date there, February 6th, this is about a month ago. So there's a month lag from the freshest amount of data that we have. In 1 month from now, they'll backfill that last month. So at any given time, you have in between a 1 month or a 2 month lag in between when the last data was released on the money supply. But again, this is indicating that the money supply growth rate is declining at a faster and faster negative pace. Real quick, by the way, I need to let you know I am launching my brand new options mastery course right now. It is available for pre-order. Options are the only tool available for retail traders to be able to make massive profits in any market, where you can make money whether or not the market goes up, down, sideways, whether you want to hedge your portfolio, make income on your portfolio. Options are the only choice available to retail traders. I've been trading options for a long time. That is my background, trading options, training professionals on how to trade options for themselves, for clients. It's in my blood, love it. And now I'm sharing all of that with my brand new options course available for pre-order. And if you get this during pre-order only, I am bundling it together with my portfolio allocation mastery course. Get that bundle linked in the description below. Again, only available during pre-order. To indicate what I'm talking about here, let's change this chart and look at the change in the money supply percentage-wise from the prior year. So we can see once the money printing started, the increase in the money supply was very high as a percentage from the year before. And in February of 2022, that growth rate just started to drop off of a cliff. Obviously, that growth rate, even though it was declining, it was still positive for a long time. And then right around July of 2022 is when that growth rate in the money supply hit historical averages. You can see this 5% line is right around where the money supply growth fluctuates, indicating, as a side note, that that's probably a lot closer to what the real inflation rate is on average. I know that there are other private, like shadow stats and things like that say that the inflation rate is, for years it was closer to 8 or 10% or 11%, but you can't just always measure inflation the same way, because inflation changes consumer behavior, which then changes what the price levels are of average items. And so it's a lot closer. You're going to get a lot closer to the target if you look at the change in the money supply. And given the fact that since, late 90s, it's been around 5%, fluctuated around that, that's probably a lot closer to what inflation was rather than under 2%. But over the last couple of months, we've seen the growth rate in the money supply drop significantly. And in November of last year, it turned negative. So the year-over-year change in how much money there is in the total money supply has been negative since November of last year. Again, this just means that if you take all the dollars that are in circulation, those dollars, the number of those dollars has been shrinking. The reason is because the Federal Reserve is sucking dollars out of circulation on purpose, because they're trying to stop inflation. When interest rates increase, it increases the cost of servicing that debt. So it requires more income being diverted from spending to servicing that debt, so that you have a lower amount of money in circulation. That's the purpose. When you can't take that income and spend that on all the other stuff, that means less demand for all that other stuff, which means prices have to adjust down. It just doesn't happen immediately. There's a huge lag, 12 to 18 months before that hits average prices. And because there's a huge lag, and because the Federal Reserve is still tightening and still sucking money out of circulation, by the time inflation stops, and by the time the CPI shows, 3%, they'll have continued to tighten all the way up until that point, which means that all the cumulative effect of all that prior tightening will continue past the point that they stop, which means that it's not going to stop when inflation hits 3%. It's going to keep on going, and it'll hit 2%, 1% will dip over into inflation, will tip over into deflation, and they will have already stopped tightening. They won't know what hit them. This is where a lot of people say this is by design. They're not incompetent, they're malevolent, and I don't think that's the case. It might be true. I just don't care. The results are the same. And you might be looking at this and thinking, that is not even a big drop. It just basically looks sideways. We've got a long way to go before we get down to where the money supply was before 2020. And that is true. And I've never made the claim, nor I would ever make the claim, that our price level would get back down to the level it was at in 2019. I don't think there's any way that prices get that low again. But when the year-over-year CPI turns negative and it shows deflation, my biggest concern is what the Federal Reserve will do to deal with that. Because it would be bad news if it's a pivot and starting to ease again, and it would be even worse news if it was a CBDC. As always, really appreciate you guys. Thank you so much for watching. Have a great day.